What is up, everybody? I'm going to be talking about the 4 things that I think that everybody buying a home over the next year needs to know. So the first thing that you need to know is all the options that are available to you. So I know this as a first-time home buyer. What you're going to hear all the time is all this information about first-time home buyer programs or down payment assistance programs. What I want to be very clear about is all of these things are marketed a lot more than they're actually used. And there's a couple reasons for that. The first reason that they're marketed so much is because they sound really good. It sounds like you're getting free money. But the reasons that people don't actually end up moving forward with them, and the reason that people oftentimes just end up going FHA, is number one, these loan products oftentimes just jack up the mortgage rates so high that it makes it really tough to qualify. Sure, you are going to be getting some money up front, but your entire loan balance is going to go up by 1%, maybe 1.5%. In the long run, it ends up costing people quite a bit of money. The second thing that happens with these programs is they often just tack on a second mortgage in the amount of what your closing costs and down payment otherwise would have been. And again, that's going to have a much higher rate. Just doesn't end up making a lot of sense. This is the reason people end up just going FHA. So what I would tell a first-time home buyer is make sure you're aware of the programs that are available to you, because there always is a cool mortgage product out there. Some of them come in, some of them go out. I think the coolest program on the market right now is something called the Hoper Mortgage. I think it is better than any DPA out there. I think it's better than any first-time homebuyer program out there. What it does, it allows anybody to join this Hoper research project. You don't have to be a first-time homebuyer. You don't have to make under a certain amount of income to qualify. You can sign up to be a part of that research project, and they will pay you $13,000 before you close. That $13,000 can be used to pay your closing costs, go towards your down payment, pay your real estate agent. It can be used for whatever you want. They are paying you a 1099 income of 3.5% of the purchase price up to $13,000. So depending on your market, it's oftentimes just going to be a flat 13 grand. And this solves one of the biggest problems that first-time home buyers are facing today. And that is when somebody buys a home and they just liquidated the vast majority of their savings account, they now have no additional funds in case there's an emergency. So if they lose a job, if a family member needs help, if something happens, they don't have that savings account to fall back on, and this can put people in a really tough situation. It's one of the reasons I love the Hoper program so much. The second thing that I would tell first-time home buyers is to get your credit in check. It is going to take about a 620 credit score, between 600 and 620. There's going to be a lot of lenders out there that talk about going down to 580, but similar to DPA products, they are just going to jack up the rate on that. It makes it really tough to qualify for the house that you want. So what I would say is when you are gearing up to try and buy your first home, I would try and get your credit score to a minimum of that 620. The higher your credit score is, the less you're going to pay in an interest rate, so it's going to make your monthly payments a little bit cheaper. So the higher the better, obviously, but that minimum is going to be around 620. Now, if you don't have a credit score, if you have a really low credit score, here's where I would start. If you don't have a credit score, I'd recommend getting a credit card. If you can't get a credit card because you don't have credit history, it's kind of like this self-perpetuating circle where you don't have credit history, can't get a credit card, don't have credit history, can't get a credit card. What I would recommend is you find a trusted family member or friend that will allow you to be an authorized user on their card. Now, the big thing here is you don't even have to have access to use the card. You just need to be registered as an authorized user. That way, when they make their payments on time, it's like you are making your payments on time. And if you don't have credit history, this is going to make a big impact to your credit score. Now, on the other hand, if you have credit, you just have a lower credit score, what I'd recommend doing is working with a credit repair company, because they're going to be able to analyze your entire situation and tell you what to pay off and what not to pay off. The credit industry is a complicated one. I don't understand it 100% because sometimes when you pay off debt, that can actually have a negative effect on your overall score. So I would work with a professional, have them be the ones to work with the debtors, handle all the disputes, and over the course of a number of months, we've seen people increase their credit score quite drastically working with these credit repair companies. The third thing that I would tell a first-time home buyer is a little bit about how they qualify to buy a mortgage. So what a mortgage company does is they look at something called your debt to income ratio. And that is exactly what it sounds like. They look at how much debt you have on a monthly basis, your car payments, student loans, housing payments, and they compare that to how much money you make per month. And they say pretty much your amount of money you make every month, you can, at an absolute maximum, spend about 50% of that on all of your debts. Now remember, that 50% is the absolute max. Some lenders cut it off at 47, some 45, it varies a little bit, but what they are all looking at is something called your debt to income ratio. What's important to understand about this ratio is the way the math works, debts hurt way more than additions to income help. So let me explain what I mean. Say you had a $700 debt. Because of the way the ratio works, that is going to decrease your buying power by way more than adding $700 to your income would add. So the big lesson to take away from the debt to income ratio is it is way easier to decrease your debts, make a bigger impact than increase your income. So what I would look at is what high interest rate debts do you have? Do you have car loans? Do you have personal loans? Do you have student loans? Take whatever is the highest rate interest debt, and if you are at a point where you can't qualify because your debt to income ratio, it's maybe worth having a conversation with your loan officer to see if you should pay off that debt. And make sure you ask yourself, hey, can I afford to pay off that debt? The other thing that I would say about this debt to income ratio is during the mortgage process, when you're shopping for homes, do not add any more debt to your current situation. Don't go out and buy a car, don't finance furniture, because these things are gonna hit that ratio, decrease how much you can qualify for, and at the same time, it could also decrease your credit score and drop you into a point where now your interest rate's going up. Now your monthly payment's going up, and maybe you can't qualify with that new monthly payment. So if you're going to buy a new car, if you want to buy furniture on a credit card or finance furniture, make sure you do that after you get the home. It's a lot easier that way than dealing with the hassle of getting all these things, having your credit score change, having your debt to income ratio change while you're trying to buy the house. And the fourth thing that I would tell anybody trying to buy their first home right now is buying the home is going to be quite a bit more expensive than you think it's going to be. A lot of people, when they talk about buying their first home, the biggest thing that they're focused on is their down payment, which is super important. But that is just one piece of what you have to pay in total when you buy a home, move into a home. You have your down payment. On top of that, you have your closing costs. You have your prepaids. That's your escrow accounts for your taxes and your insurance. Sometimes you have an HOA account set up. And on top of all of that, you have to finance a house. So what I would say is whatever down payment amount that you're shooting for, and you can work on creating a target with your loan officer, you're gonna wanna add quite a bit of money on top of that to cover all of these additional expenses. Now, one thing that you absolutely can do is work with your real estate agent, work with your loan officer to have them ask the seller's agent to help cover a lot of these things. There's a couple ways that you can do that. You can put in an offer that includes a certain amount of seller concessions, or if you already have the home under contract in some scenarios, and depending on where the appraisal comes in at, you can actually bump the purchase price by $10,000 and then ask the seller for $10,000 towards your concessions. That is, at the end of the day, it is the same thing to them. But if you have that room in that appraisal and it works out in your qualification, that is a phenomenal way to go forward. Have your closing costs, maybe your prepaids, covered by the seller. But all of this to say is buying a home is really expensive. Not only do you have to do everything we just talked about, but you also have to furnish this thing. And once you buy this home, you're gonna be excited. You're gonna want the couch, you're gonna want the TV, you're gonna want the dining room table. All of these things add up really fast, and I just want you to think about how much more money on top of your down payment and everything this is going to cost, and just plan accordingly. And this is the big reason that I am such a large advocate for the HOPR program. So with the HOPR program, like I said at the beginning of this video, you get 3.5% of your purchase price, or $13,000, whichever is less, paid to you prior to closing. And on top of that, a part of this mortgage product is you are actually going to roll a solar system into your mortgage. And when you buy solar in the United States, you actually get a 30% tax credit. So if we look at this entire program, you are getting $13,000 paid to you via 1099 prior to closing. On top of that, you're getting a 30% tax credit. Let's call it $10,000. That is a total of $23,000 in your bank account that otherwise would not be there. And this money can be used to help pay that down payment, help cover some of the closing costs, and on top of that, help cover some of the expenses that you're going to incur after you move in the house. And it can also help in case you run into an emergency. Like I talked a little bit about earlier, a lot of first-time home buyers liquidate most of their savings account when they are going to buy a house. This additional money from this loan program can help you be in a more financially stable position after you close, because now you have a little bit of your savings account replenished. Now you can maybe afford an emergency, or maybe afford to live for a couple of months if something happens to your job. This helps people be in a more financially stable position when they close on their home. So those are the 4 things that I would tell anybody looking to buy their first home in 2024. Number 1, be aware of what products are available to you. Like I said, I really like the HOPR program. Number 2, set yourself up for success by working on your credit prior to going and applying for a loan, you can start now. Number 3 is understanding how mortgage pre-qualification works. It's all going to go on that debt to income ratio. And like I said, decreasing debts is going to be way better than trying to increase your income. And number 4 is buying a home is going to be a little bit more expensive than you probably think. There are some steps and there are some programs you can work with your real estate agent and your loan officer to help you be in a more financially stable position after you close. Thank you guys so much.